Creamer Media's Mining Weekly Online is talking to Niël Pretorius, the CEO of DRDGold. Niël, what are the key things we should take away from your interims being presented today?
Well, Martin, it's a mixed batch. There's some really good news on the one hand. We've got the Far West operations taking off quite nicely. But then I think there's also the mood around Eskom and the impact that it had on our production in the East Rand, the ergo production. I think on the whole, the results are disappointing. We would have loved to do better. But then again, there's some positives to take out of this as well. The fact that we've built up better resilience against power interruptions, etc., over time. So if this had happened 5 years ago, I suppose things would have been much worse. It could have been a real crisis for us.
You lost something like 11 days even before this crisis, which looks much worse. But you have taken steps to try and be more resilient, as you say. What are those steps?
Well, the 11 days that we lost were infrastructure failures on the part of Eskom. Load shedding is a different story. So with load shedding, we in fact have a curtailment arrangement with Eskom. So if there's stage 1 through to the various stages of load shedding, then we reduce our power consumption by either 10% or 20%. And 10% is merely just a moving around of our pumping regime. So we don't pump water at that particular point in time. That doesn't impact on production. 20% means having to bypass and switch off pieces of infrastructure, like the fine grind mills, for example. They don't run when we have to do 20%. So load shedding, although having to drive into Sandton on a day like today with traffic lights not working and so forth, it's more of an inconvenience, but the impact of load shedding is more structured and it's manageable, although of course in the long term it could be very damaging. But it's the infrastructure failures that we suffered through in December, and those were the real blemish on the numbers, the real impact on the numbers. And
do you foresee that sort of infrastructure has been upgraded to a point where it is less of a risk?
No, I think it will continue. Look, some of it's weather related, but typically what you would find is, let's say the lightning knocks out a piece of infrastructure. In the past there was inventory and they could replace parts and so forth. Now they've got to go and scavenge for parts somewhere else where it's not used or required. So I think on the whole the condition of Eskom is poor. It's in a bad state. It doesn't have inventory. I think it's allowed the grid to fall into disrepair, or at least not kept to the required state of maintenance. So I think that we will have more and more of those as well, or it won't reduce. I think we will have these events from time to time. And if you don't have built-in resilience to overcome that, I think it could impact on the numbers. It doesn't happen every day. I mean, it was an exceptionally difficult month, December in particular, with almost a perfect storm with regards to infrastructure and weather and so forth and so forth. That sort of thing doesn't happen every month or every year. But the state of readiness on the part of Eskom to deal with it, I don't think is any better now than what it was 6 months ago.
And is the energy risk greater out at Ergo on the East Rand? And will you experience the same risk on the Far West Rand?
The Far West is far less of a risk because there we're on dedicated lines towards mines, dedicated grid that go towards mines, and I think there's perhaps more caution because you can't have an interruption with several thousand people underground. So we benefit from that. On the East Rand, we've got several points where we draw power from. So obviously, and it's a much wider, it's a much larger footprint. There are 8 reclamation sites that span 60 kilometers over 2 municipalities and so forth. So clearly there's more of a risk. But yeah, we deal with the risk on the basis of making sure that if there's an interruption, that we could keep the whole process fluid, we could keep the business fluid for that period, and when the interruption is over, we can hit the ground running again.
Mineral reserves are a big thing in your company, and you seem to have nearly doubled your mineral reserves, which is a very strong point for you.
Yeah, very much so. I think the Far West deal was a very good deal for us. The Sibanye-Stillwater deal was a very good deal. It's not just a reserve equal in size to the one that we've got, but it's also contained in an ore body that has a higher grade. So you have to mine fewer tons in order to achieve similar production at not higher than our usual cost. So your cost per ton are likely to be similar or even lower. and the value of each ton that you process is just so much higher. So for us, it's come at exactly the right time. It's almost like when we bought Topstar. Topstar came at exactly the right time. This comes at exactly the right time and enables us to keep the business stable, forward-looking, invest the right sort of capital, get through this phase of Eskom restructuring and recovering, and then hopefully we'll be on a very good wicket going forward.
But you did your part. You got off to a flying start. I've never seen sort of start to commissioning move so fast.
We're very fortunate in the combination of assets that we managed to acquire with this. It's a very large resource. It's 250 million tons, but 80 million tons of higher grade material can, at relatively modest volumes, be mined through existing infrastructure, and it required about a 300 million rand investment in capital infrastructure to set everything up in order to start processing that. So it was really the combination of infrastructure and the resource that enabled us to get going quickly.
And when will you reach the high point of the Far West Rand gold recoveries project, and how quick is payback?
Well, payback's starting immediately. Payback will start virtually within the next 6 months with positive cash flows, after volume ramp up to between 400 and 500,000 tons per month. And the quality of the ore body is such, and the initial signs that we're getting out of the plant are such that the anticipated cash flows are very attractive. That's phase one though, so there's early payback on phase one, enough to more than adequately cover the cost of this transaction. But in the long term, we obviously want to do phase two as well. We want to also access the remaining 210 odd or 170 odd million tons of lower grade material and ensure that we don't take too much out of the high grade material in order to diminish the future value of the remaining ore body. So for 2 years, we'll be doing studies on what the best combination of resources would be, what the optimal volume throughput design ought to be. We'll start working on our deposition site probably within the next 12 months. The administrative work around that is happening as we speak, and that should start in about 2 years from now, depending of course on the economics at the time: gold price, availability of services, availability of capital, and financial feasibility. We don't want to dilute cash earnings per share. That's really one of the key drivers for us. So unless that becomes less of a driver and there's more of a growth component built into the valuation of the stock, we would be reluctant to simply just spend lots of money in order to produce more gold, whilst not adding to the cash earnings per share. So we'll take a long and a hard look at this, but we're very determined to tick all the boxes and put ourselves in a position to take the right decision. We really do want to mine most of that ore body for as long as we possibly can.
And at East Rand, you are completing 3 projects. Is that going better?
It has, yes. Look, I think the East Rand, with the lower values, is always going to be volume sensitive. So you want to make sure that your ability to process large volumes, that ability is always enhanced with the sort of capital infrastructure changes that you make. And then we've also added a bit of a sweetener on the grade side by moving mills from Crown across to Ergo. Which means that a lot of these little spots of high-grade sand material that doesn't belong to us, but which the owners may want to sell to us, or where they want to clear a piece of land, that we can start receiving some of that material as well. So maintaining volume throughput capacity, whilst at the same time also adding just that little bit of cream on the top for a bit of extra margin.
And you're looking after Mother Nature, you're using less potable water as well.
That's important for us, both from a commercial perspective, financial perspective, and also from a nature perspective. We've put ourselves in a position where we can source other sources of water at a lower cost than potable water, and it's working. I think it's sustainable development in action.
And just a word on your social capital. The President has challenged people to 10 points where he wants them to look at that social contribution as well, and you make it out on the East Rand.
Very much so. We pitch our social development initiatives at just one level above abject poverty, because I think that's going to be a catalyst. You can't talk to somebody about starting his own business if he's sitting there with an empty tummy. So we want to make sure that the programs that we have, considering the communities living around our operations, that those programs are relevant for those communities, and that it contains a component of self-empowerment. And then it's just so much easier to bring the knowledge-based social capital initiatives or programs into that community. That, of course, and youth education, which has been one of our successes. It's been a very successful program.
Thanks very much, Niël.